Good debt. Today's topic is good debt. Is there such a thing? If so, what is it and how can you benefit from it? I'm Lachlan Campbell and this is Mad Success, where we're providing you with life success and financial well-being content. Come check it out. So good debt. We have two conflicting views on what is good debt. We've got the Dave Ramsey School of Financial Well-Being, and we've got Robert Kiyosaki's Financial Education. They have opposing views. Dave Ramsey believes you should never take on any kind of debt. None. Except maybe for your own home, take on a mortgage, fine. But otherwise, no debt. Why is that? Well, when Dave was young in his 20s, he amassed what he says he became a millionaire through real estate, but when real estate prices crashed and he had tenants that left his properties, he couldn't pay the mortgages and the banks took the properties away from him. Foreclosed on him. That's called foreclosure. And so Dave, I think, has been sort of once bit, twice shy, and it's made him sort of decide, I'm not going to take on any more debt to build my wealth. And he's a very wealthy guy and he knows finance inside and out. And he could certainly use mortgages to build a property empire, but he chooses not to, and he recommends you don't touch debt. So on the other side of things is Robert Kiyosaki, the author of Rich Dad, Poor Dad. If you haven't read the book, it's a classic in the financial education space, and it talks all about how to manage money, look after money, what his rich dad did versus what his poor dad did, but it talks a lot about real estate, and it talks about using other people's money, bank, mortgage, or other, to build wealth and build a property portfolio. Robert is living proof of this, and he lives, what he speaks, because as of 2020, I saw him on YouTube, he had 6,500 properties, primarily using other people's money to build his property portfolio and build his wealth. I believe in the Robert Kiyosaki side of things. Now, if you are an unsophisticated investor and you don't understand real estate or equities or bonds, you've got to do your financial education. Check out our other videos and really teach yourself the languages of money. Really learn about economics, accounting, and investing. Okay? Now, if you're a new investor and you're an inexperienced investor, or even if you've got some experience, it's really important to understand the risk-reward trade-off in using debt to buy assets. So Robert Kiyosaki believes in good debt. He's probably actually the person that first coined the phrase good debt. So what is good debt? Well, let's just take a step back and say, what is debt? Debt is an IOU. You borrow money from someone, whether it's an individual like a family or a friend, or you borrow from the bank, and you're borrowing money. And then it's usually for a certain period of time. You borrow for 6 months or 1 year or 5 years, and it's usually got an interest rate attached to it. So you're borrowing money and you're paying that person or that bank for the right to borrow their money. So they're going to charge you a fee. They're going to charge you a certain amount of interest. So let's say you borrowed from a friend $10,000 for 1 year at 5% interest. Well, in 1 year's time, you'd have to pay back the $10,000 and you'd have to pay the 5% interest, which on $10,000 is $500, right? So your cost of borrowing would be $500. That's what debt is. Debt is borrowing money and you have to pay it back. If you don't have it pay it back, then that's a gift, right? If your parents gave you $10,000 and said you don't have to pay it back, that's not a loan, that's not debt, that's a gift, okay? So bad debt is using borrowing to buy stuff. Think credit card, right? High interest credit card debt is the worst kind of debt that you can take on in most places, because the interest charge on just buying stuff is a huge penalty. If you're not paying off your credit card regularly in full each month, your cost of borrowing is outrageous, and you should never have an ongoing balance on your credit cards. It's the worst kind of debt. If you do, go and talk to your bank and see if you can get a consolidated loan at a much lower level of interest. Pay off your credit cards, and if you don't have good self-management and good self-control of your spending, cut up your credit cards or freeze them in your freezer, and don't use them for borrowing. Okay? So bad debt. I have a video here that goes deep into details of what is bad debt and all the consequences. I'm not going to go into that here. This video is about good debt, and I'll be quick. You use debt to buy cash flowing assets, what you've maybe heard as passive income, okay? So there's three traditional assets: bonds, equities, and real estate. Bonds right now don't offer enough cash flow versus the cost of borrowing to justify going into debt to buy bonds. There's just not enough return. There's not enough to increase return in bonds. You need to go deeper into credit risk in what's called non-investment grade or junk bonds, double B, single B, triple C, and beyond. And that's too much risk to take on for so little return in today's market. So just don't do it. If you want to buy bonds, pay 100% cash, put them in your portfolio, or buy an ETF, bond ETF, but please don't borrow money to buy bonds right now, because the risk reward, the trade-off is just not good enough right now in 2022, okay? Equities. Many professional investors borrow money, what's called borrowing on margin, to buy equities. If you're a new investor, beginner investor, or a slightly experienced investor, I strongly urge you not to borrow money to buy equities. Why? Because of the price volatility in the equity market. As you can see now, it's August 2022, stocks have crashed. Right? Some stocks are down 20%, 30%, 50%, 70%, even more in some cases. Some of these meme stocks have just completely plummeted. If you borrowed money last year in 2021 for 1 year to buy these stocks and the price crashed and your loan is coming due and you wanted to sell the stocks hoping you had made a big gain, now you've made a big loss, you have to find the money to pay back the loan. That's the risk. Right? You want to buy stocks for dividends, fine, but because in the stock market, banks are never going to really, a broker will lend you to buy stocks, but a bank isn't going to lend you money to go buy stocks. They're just not. In some countries, maybe, but you'd have to take out a personal loan to go and put it into the stock market, and I do not recommend doing that, and Dave Ramsey would not recommend doing that, and Robert Kiyosaki would not recommend doing that if you're an inexperienced investor, okay? So what does that leave you with for good debt? Real estate. I use mortgages to buy real estate. I have a property portfolio of multiple rental properties. I follow the Robert Kiyosaki school of thought around leveraging to buy rental properties. But I'm super conservative. All of my mortgages are at only 50% loan to value or 60% loan to value. What does that mean? It means I put my down payment, my deposit was 40 or 50% of the price of the real estate. So I don't take on that much debt. I leverage it somewhat, but I don't take on so much, which means my total returns on my cash flow will be less because I'm not borrowing as much money. Robert Kiyosaki probably borrows at a much more aggressive rate, maybe at 80% loan to value, 90% loan to value, but he has so much cash flow now from his properties and he's sold so many properties over the years, he doesn't worry about that. For me, I'm more conservative. I'm not the Dave Ramsey type that says no debt. No, I don't believe in that. I think you can borrow to buy rental properties, but if you're taking on higher risk by only, say, if a bank lets you only put down 5% for a rental property and you borrow 95%, you're going to have much larger interest payments. And if a tenant leaves or the market crashes, you expose yourself so much more to the risk of having to pay back that loan or sell the property at a loss and then having to pay back that loan, or the bank could foreclose if you can't pay the cost of the mortgage. Much higher risk. So be conservative, definitely. So let me get back to the point. Good debt. We borrow to get cash flow. So here's an example in real estate. Let's say you live in a smaller city, small town, and you could buy an apartment for $100,000. Now I know in big cities, very unlikely you're going to find anything for $100,000 other than a tiny shoebox. But let's say you could buy a property for ease of math for $100,000. Let's say you then did a 30% down payment, okay? And your borrowing was 70% or $70,000. So what is the good debt side of it? Well, we learn in real estate investing that all the money that you're going to make is discovered upfront in the calculations. So if you're taking on a property and you expect that the market's going to fall, you may not want to buy at that time. But if you know you're going to hold it for long term, and you're not trying to flip the property in 2 or 3 years, you're not trying to do, different strategies where you're going to flip it, but you really want to hold it long term, then I would just say, you want to buy anytime. Buy today, buy tomorrow, buy the next week, even if you think the property market is going to come off. If it is, okay, maybe you wait 3 months or so, but net, this video is not about strategy, it's about good debt, okay? So you have a 70% mortgage. Let's say on that mortgage, your cost of borrowing is, say, $1,500 per month. Well, let's say the rental property in your town, for that $1,000 apartment or home can get you $2,000. So your cost of borrowing is $1,500 and the income is $2,000. But so you think you have a net $500 per month. But in real estate, in rental properties, you need to account for annual expenses like insurance and taxes. You need to also account for ongoing maintenance. And so what we say as a general rule of thumb in real estate is you need to set aside monthly between 10 and 20% of your property income to allocate towards maintenance and annual costs. Okay, so 20%. So 20% of $2,000 in rent is $400. So you have interest cost on your mortgage of $1,500 in this example. You have income of $2,000 and your 20% to set aside is $400. So $1,500 in interest plus $400 in other is $1,900, which only leaves you $100 in net profit or cash flow, okay, your passive income. Now, in some markets, that's fine. If you know that your market is super stable and over the last 50 years, house prices, yes, they've gone down a bit, but you're planning to hold long term, and your view is you want to start, acquiring more and more of these $100,000 properties, okay, you're not going to get much cash flow. But up front, for most people, that $100 over the $2,000 is not enough of a return, okay, for investors. So I invest primarily in the north of the UK, Manchester, Birmingham, but also outside of the bigger cities in places like Glasgow. I invest in a place called Hull and smaller cities around Manchester. And why do we do that? Because the rental yields are much higher in the north of England than they are in most other countries around the world. Vancouver in Canada, for example, often the rental yield is negative. You're actually paying money each month to cover your mortgage because the rents are just not high enough to cover the cost of mortgage and maintenance. So good debt is used to create cash flow. So you want to do your calculations up front. Ideally you want to be earning at least 5 to 10% in cash flow if you can in the property to be able to kind of justify it and make it a good investment. But you're using debt to buy cash flowing properties to hold for the long term. That's what good debt is used for. Yes, you can use debt to flip properties. You can buy, if you're in a booming housing market like we had over the last 10 years before interest rates started rising, great opportunities were had to borrow for short term, renovate, what they call below market value properties, renovate them, add value so that the sales versus what you paid, say you paid $100,000, you put in $20,000 in renovating costs, and the new property could be sold for $200,000 9 months later, great. You could make $80,000 in profit in a very short period of time. And that's a strategy in real estate. And you can use debt to do that. And that's what I would call good debt. But in this example, what I'm talking about is just buying long-term cash flowing properties. I'm not talking about these other strategies in real estate. So to summarize, good debt can be used to buy traditional assets. It can also be used to buy what are non-traditional assets, like going out and buying a yacht that you rent out through charter, or you're buying, say, a car that you rent to Uber drivers and they pay you a fee for that car. These are some of the non-traditional ways that you could maybe borrow money to buy these assets. But again, you'd have to do the calculation. What does it cost you? What's the cost of the loan versus how much income do you expect to receive from the asset to justify whether you should be borrowing to buy that asset or not, and what is the risk, right? If you had a car accident or the boat sank, what's that going to do in terms of how your inability or ability to pay back the loan? Okay, so I hope you got value from this video. I hope you'll share it with friends, families, and colleagues if that moves you and you think that they would benefit from it. And I just want to say thank you for watching all the way through. I'm Lachlan Campbell, and this is Mad Success. Cheers.